Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. U.S. stock market June close and consumer stocks analysis. This video presents a direct informational narration of the source document.
Here is a quick look at our agenda for this explainer. We'll start with the June market close and market breadth, followed by a look at May's macroeconomic data and sector performance. From there, we'll break down consumer classifications, and finally, we'll dive right into an analysis of specific discretionary and staples stocks. Let's move right into Section 1, examining the June market close and underlying market breadth. So looking at the closing data for June, it's pretty clear that although the major indices ended higher, the underlying market breadth actually showed some real structural weakness. Within the S&P 500, only 213 constituent stocks advanced, while 290 stocks declined. If we exclude technology, industrials, and some slight gains in basic materials, 7 out of the 11 major sectors actually closed down, with 3 of those sectors falling by more than 1%. What this indicates is a highly top-heavy market structure where just a handful of large-cap stocks are doing the heavy lifting to drive index gains. For anyone holding a traditional, broadly diversified portfolio, this lack of breadth essentially acts as a penalty, leading to relatively poor recent performance for those types of accounts.
Now, what's particularly interesting here is the specific driver behind these sector declines. Many of the sectors that took a hit on the last trading day were actually the leaders earlier in June. This localized sell-off was heavily influenced by end-of-month pension fund rebalancing. As for the technology sector, there's a bit of a perception gap. While some individual tech subsectors definitely saw high volatility, the broader technology sector as a whole barely moved in June, driven only by a minority of advancing stocks.
Moving right along to Section 2, let's take a look at the May macroeconomic data. The first critical data point here is the May U.S. job openings, also known as the JOLTS report. Job openings remained relatively flat, showing just a slight decrease from 7.618 million down to 7.594 million. But crucially, this number still beat the market expectation of 7.30 million. The overall job opening rate held steady at 4.6%. When we look at industry-specific shifts, the healthcare sector saw quite a significant drop in vacancies, whereas sectors like manufacturing, construction, and distribution actually saw increases in available positions.
Our second macroeconomic data piece is the U.S. Consumer Confidence Index. This metric declined from 93.1 to 91.2, completely falling short of the expected 94.8, which indicates a generally pessimistic outlook. While views on the broader business environment improved slightly, perceptions of the labor market deteriorated quickly. About 24.9% of respondents felt jobs were plentiful, which is a very marginal increase from 24.8%. However, 22.5% of respondents stated that jobs are hard to get. That is a notable jump from the previous 19.8%, and it brings this specific metric to its highest level since January 2021. The source document points out that the expanding application of AI is appearing to be contributing to this less optimistic employment outlook among respondents.
Let's transition over to Section 3, our sector performance summaries, to see exactly how capital flowed in June.
Taking a look at the complete June performance across the 11 S&P 500 sectors, we see an almost even split. 6 sectors gained, while 5 declined. Surprisingly, technology wasn't the top performer here. Industrials actually led the market with a solid 7.25% gain, followed closely by healthcare at 6.62%. On the downside, the communications sector was the absolute biggest loser, dropping 7.16%, followed by energy, which fell 4.97%. Now, that sharp decline in communications might seem highly counterintuitive to a lot of people, but it is directly attributable to the heavy index weighting of one major component, Meta, which essentially dragged the entire sector down with it. This perfectly illustrates the contrast in market momentum. The technology sector actually declined by 0.14% in June. I know, this totally contradicts retail perception, but it makes complete sense when you remember that it followed massive gains of 20% in April and 19% in May, meaning it essentially just traded sideways for the month. Meanwhile, looking at the consumer segments, consumer staples posted a minor gain of 0.89%, while consumer discretionary dropped by 2.78%. The primary pressure squeezing these consumer sectors stems directly from high inflation expectations. When elevated oil prices transmit their way through the broader economy, consumer wallets naturally tighten, leading to direct negative impacts on consumption behavior.
Next, Section 4. Let's clarify how these consumer sectors are actually defined.
Under U.S. industry standards, the classification of consumer staples versus consumer discretionary can actually be quite counterintuitive. For example, restaurants like McDonald's or pizza chains are classified as discretionary simply because they provide a value-added processing service. On the flip side, things like tobacco, alcohol, sugar, meat, and supermarkets are classified as staples. In an environment dominated by high inflation expectations, discretionary businesses really struggle to raise their prices without simultaneously reducing the frequency of consumer transactions. Staples, however, retain much better pricing power because they represent essential expenditures. Consumers still have to buy their groceries regardless of slight price increases, making these businesses structurally more resilient, though, of course, they aren't entirely immune to broader market pullbacks.
Let's move into Section 5, diving into our targeted discretionary stocks analysis. We'll start with McDonald's and Nike.
The crucial takeaway regarding McDonald's right now is its forward valuation. Based on 2026 and 2027 estimates, the stock definitely appears undervalued. However, its overall growth rate has noticeably decelerated from the low double digits down to the high single digits. Because lingering inflation pressures severely limit their ability to defend profit margins, the market is actively discounting its forward price-to-earnings multiple. From a technical standpoint, to signal true stabilization, the price really must cross and hold above that 286 resistance level. Support currently sits in tight clusters starting from the 260s, specifically at 260 and 267, all the way down into the 239 to 256 range, and finally down to the 223 to 228 range. Due to the recent end-of-month rebalancing distortions, we just cannot conclude yet that the stock has found a firm bottom.
Shifting over to Nike's Q4 earnings, the top-line numbers actually showed a beat. EPS came in at $0.20 against an expected $0.12, and revenue hit $10.97 billion versus the expected $10.85 billion. However, when we look at the underlying business details, it reveals some significant weakness. North American revenues were basically flat, actually declining 3% on a constant currency basis. Markets in China and the EMEA region remain incredibly soft, but most notably, Converse brand revenues absolutely plummeted by 33%. Both the direct retail and wholesale channels are currently operating under severe pressure.
Technically speaking, Nike faces an arduous path forward. Their forward PE estimates are fundamentally mismatched with the company's declining historical momentum and shrinking regional sales. To show any real sign of stabilization, the stock absolutely has to cross that 47.5 resistance level. Downward support levels do exist around the 38.4 and 41.8 marks, but it is super important to note that these are 12-year-old technical levels. This means their current reliability is highly questionable. Furthermore, there is a looming systemic risk. Nike is a component of the Dow Jones Industrial Average. If this prolonged operational underperformance and depressed price action continue for another 6 to 8 months, there is a very tangible risk that Nike could be removed from the Dow Index altogether.
Now, for our final section, Section 6, let's shift our focus to staple stocks analysis, specifically looking at Costco and Walmart. Costco serves as a great demonstration of the relative resilience of consumer staples. The stock retraced from 1096 down to 935, which is a comparatively modest drop. The stock supports a very high forward valuation multiple, primarily because of its incredibly strong pricing power. They can offset profitability pressures simply by raising their membership fees. However, keeping a high valuation without rapid growth inherently limits upward momentum. Technically, there are continuous support levels down to 867. A definitive break below 867 would completely invalidate the current structure, signaling a mean reverting bearish trend that targets levels below 800. Therefore, the source cautions investors to patiently wait for a wider margin of safety.
Walmart's situation is structurally quite clear. It is severely overvalued. While the company has executed a highly successful e-commerce transition that's driving solid growth, the current market price of roughly $113 vastly exceeds its January 28 forward upper bound valuation of just $77. The current support zone rests between 104 and 92.8. The critical risk here is that if the price breaks below 92.8, it will likely trigger a massive 1.5 to 2 year bearish adjustment phase, targeting price levels well below 70. The premium has simply been stretched too far at this point.
To wrap things up, if you view the broader market as overheated, but also recognize the structural risks present in consumer stocks right now, it's important to remember you don't necessarily have to force capital into equities. Because inflation takes real time to unwind, prices rise instantly but fall slowly, and interest rate trajectories remain pretty ambiguous, taking a defensive position is entirely prudent. Cash itself is a highly viable hedge. Utilizing money market funds, cash accounts at brokerages, or short-term treasuries currently offers yields ranging from 3% to over 4%. This provides a very low-risk return while preserving your capital flexibility, allowing you to patiently wait for much clearer market trends or definitive market bottoms. As the disconnect between a few top-heavy tech stocks and a structurally strained consumer base continues to widen, the ultimate question remains: will this defensive positioning soon become a necessity rather than just an alternative?